Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, and welcome to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host. Welcome back. We got a great guest today, Mark Willis. We'll introduce Mark in just a second. But just a quick reminder, if you haven't already done so, please feel free to subscribe to the podcast. It's on Stitcher, iTunes, iHeartRadio, and altogether 30 different channels you can choose from. The podcast is also being downloaded in now more than 50 countries. So if you are in a country outside the U.S., you can do everything we're talking about here in the United States. And you can do these things in other countries too, but most people are interested in investing in the United States. So we have ways for you to do that. There are channels to follow and professionals to help you do that specifically. For everybody though, professionals, business owners, welcome aboard. By the way, as something that's come up in the last year, becoming more and more of a factor, is the fact that we do have investor agents around the country. A lot of them. They're certified investor agents. They only can get that certification in one place, and I know that because I'm the place. We train them specifically to work with us investors. They focus on the small commercial and residential multi-units and flipping and things like that. So go to the website, realestatewithgarywilson.com, click on the members area tab. And when you go in, you'll see on the left-hand side, if you're a member, you know what to do, obviously. If you're not a member, click on the right-hand side and join for free for up to 30 days. And while you're there, grab everything you can grab for free. Books, training material, jump on our weekly classes. I mean, there's an abundance of things for you, so you can kind of test the water before you move forward, which I highly encourage you to do. Education is the key to success. So get the education first and get the information, and we'll help you out. In any case, welcome aboard, Mark. We're glad to have you. I know you're a busy guy. I know you're successful, and I know we're blessed to have you on board here. So welcome aboard.
Thanks, Gary. Thanks to be on your show.
I'm glad to have you. Hey, if you wouldn't mind, I actually have some information. I was doing some research, and I love your background. I love what you're doing. But I like to have the guests actually do their own introduction. The reason is if I read an introduction, it sounds like I'm reading an introduction.
Right.
Wouldn't mind. We want to hear right from the guy. So if you wouldn't mind, paint a picture for us.
Sure.
And then we'll get started on some details.
Well, at the expense and risk of sounding like a jerk by self-promotion, I guess I'll share a few things that we've been up to. Certainly wasn't born into all this. It's been a hard and well-fought journey, still learning, still growing. But thank goodness I've had the privilege and the ability to work through some major obstacles to get to where we are today. And as of today, I'm the owner of Lake Growth Financial Services. I'm a certified financial planner. Which is, your audience might know, is the top designation you can have for personal financial planning in this country, the United States. I live and work out of Chicago, Illinois. I have a wonderful wife, a beautiful daughter. We have been working for over 11 years now in the personal financial planning space. And we can get into some of my history there. But I've had the privilege of training other advisors that work around the country with me. We've got several hundred clients all across all 50 states. And co-authored 3 books, all of which revolve around financial planning strategies, one in which focuses on some of the real estate strategies we might be sharing with your audience today. So I'm really excited and can't wait to get into what we're going to cover together today, Gary. Awesome.
Well, thank you very much for sharing that and being candid and humble at the same time. So it's a great way to endear yourself to people. And I love the fact that you're from the Midwest, Chicago area, Illinois, and a beautiful part of the country. And, a lot of great business ideas come from that part of the country. So in any case, one of the things we were talking about, Mark, is, how to leverage a whole life insurance policies. And it's not something we've spoken about much on the podcast. It's come up once or twice, but for the folks listening, we have a lot of professionals and business owners, and even lately more realtors coming on board who want to invest also and protect what they've got. So if you wouldn't mind, can we touch on that? And what is that strategy? How can we use whole life insurance other than just the death benefit that most people think of it as,
Well, yeah, there's a quote by Mark Twain. He says, "A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain." That to me summarizes why banks can't be our only tool in the toolbox. Not to get rid of them, but to put them in the right proper context so that we use banks for our convenience as investors, rather than letting the bank use us for their convenience. And if we are constantly dependent, like a parasite and a host on a bank, then it's going to come around to bite us. The wonderful thing of leverage is that we can use a little bit of pennies to buy a lot of dollars. But boy, leverage can work the other way too, as many of our clients learned, well, in 2008, but then again in 2020 when rents started going on moratoriums and more. And, who knows the future when folks are listening to this, what's happening to your real estate market since it's all local. So I'd like to take you guys really quickly to a story. I was just talking to a client. We were working on some financial strategies with him. He's been a very successful real estate investor. He had 20 properties. He just sold 10 of his properties to wipe out the mortgage on the remaining 10. So he had 20 mortgaged properties, sold half of it to pay off the other half. And he was just describing this and was very happy about this. And I agree. I mean, wow, way to go, building up that kind of portfolio and then being cleared of all mortgages. Wonderful job. And as we got into the conversation, we were discussing, he was even doing a tile and grout while we were talking. It's just kind of casual client conversation. And he was telling me how much he knows, he can feel, he can see, he can hold in his hand the value of real estate. And I would say most financial planners, most certified financial planners, have discounted the value of real estate in one's portfolio. We don't look at it the same way we look at stocks, bonds, mutual funds, ETFs. A lot of financial planners will say, well, real estate's just not liquid, or hey, you can't really access the cash. I would disagree. I would say, we don't want to just look at instant liquidity. We want to look at lifetime liquidity and how much rent money will you be able to draw on a rental property versus a savings account, for example. Immediately liquid, yes, the savings account, but how much rental income will you get off a savings account? I'll say none, right? And let's go through history. Has real estate or savings accounts lasted longer? I mean, real estate goes clear back to the pyramids. And so I would say there's absolutely a blind spot in most financial planners' perspectives when they don't look at real estate as an absolutely quintessential and important part of one's financial life. Okay, so back to my story with this gentleman. He was describing how important, how tangible the real estate in his life has been. And again, we congratulated him for paying off the mortgages. But then I said to him, hey, well, wait a minute. How much of a real claim do you have on those remaining 10 properties? And he said, well, I've got the claim. I have the deeds. I have the absolute right. There's no mortgage on these properties. And I said, well, is it really the bricks and mortar that give you the right to those properties, or is it a contract? And he thought about it and he said, no, actually it's the deed. It's the piece of paper that says I own this property. It's the contract that really relates my wealth to real estate. Otherwise, all he has is squatter's rights. The renter is just the one with the shotgun. He's going to own that property, right? So at the end of the day, the contract is what matters more than anything else. In civilization, and in Western Civ especially, it's the contract that brings the value. Now, there's kind of two major components to the financial world. There's the paper assets of Wall Street. I call those retail amateur investment products. Retail amateur investment products where you're feed to death and taxed to high heaven in the stock market. Or there's contracts. So there's paper wealth on Wall Street or contracts. Real estate is one type of contract, and it just so happens attached to that contract is bricks, mortar, sticks, lumber, all that. Another kind of contract, Gary, is the insurance contract. And that finally brings me to whole life insurance. So I'll stop there. What are your thoughts, feedback? I'd love to get your feedback on this so far. Well,
I like the way you're going with this. When I studied, I have my broker's license. When I studied for the broker's license, I learned that, like your client, he thought he owned his property, but the reality is there's multiple rights of ownership, right of possession, right of quiet, peaceful enjoyment, equitable rights, things like that, contractual rights. And at the end of the day, one easy test is to ask yourself, what happens if I don't pay property tax?
Yeah.
So,
right.
It's the thing about squatters' rights too. That always baffled me that there was a law that actually says, if you don't show up at your property for a period of time and someone else does and they start taking care of it, they can claim some sort of rights against that property.
Wow.
And so in any case, it's an interesting subject. So I'm interested to see where you're going with this. But I like the explanation, and I think you got a lot of people's ears are now paying attention.
Well, it's all in concert, and we were talking before we hit record about the both and concept, and yes. I don't want anyone to perceive that we should say stop doing this, start doing that. It's a both and. So how do we incorporate the contract philosophy where we can build true wealth, not paper wealth, but true wealth outside of Wall Street with tools like real estate and insurance contracts together? In fact, we might get here throughout our conversation today, Gary, but I'm going to end up recommending that folks consider putting and pairing two financial vehicles together, like peanut butter and jelly, like wine and cheese, like Thelma and Louise, like nitro and glycerin. Mm-hmm. Sometimes things are better together than when you leave them apart. They're great alone. Real estate's fine by itself. Whole life insurance, strange as it might sound, is better when coupled with other assets like real estate. So what is whole life insurance? How in the world does that have anything to do with our real estate portfolio on this side of the grass? On this side of the grass. I think a lot of people understand life insurance as the money you leave your family when you go to the other side of the grass, so to speak. And that's fine. And that's true. I mean, I've never met anybody who, was going to receive a giant 7-figure inheritance and said, no, thank you. But the real value of today's conversation is the living benefits, not the death benefit, but the living benefits of life insurance. Mm-hmm. And that's where things get really compelling for me as a CFP, as a certified financial planner, and personally, just my own financial life. So I'll tell a quick story. We were in debt up to our eyeballs when we graduated college in 2008. Gary, we had no jobs. We had 6 figures of student loan debt. We had no plan or awareness to pay off the debt. And we started following the snowball method, paying off the debts the old-fashioned way, just throwing money at the problem, burying our money in the ground, basically. And we woke up one day and said, well, wait a minute, we just paid off, 70 grand of this debt, and we have nothing to show for it except a bunch of thank you notes. Thank you for your payment. Thank you for your payment. And we were helping support the retirement of Sally Mae and her cronies with all those debt payments. As we discovered a typical or a not so typical design of whole life insurance, what we call bank on yourself type whole life insurance, has the capacity to help us become better than debt free and to make payments on all of our major purchases in a way that beats even paying cash. So what is bank on yourself designed whole life? If it's designed correctly, Gary, it will build and grow on a guaranteed basis every single year for the rest of our life, guaranteed by the insurance company. So that's huge. It's accessible money. We don't have to wait for someone to give us permission to touch our own cash. We don't have to wait for some special birthday. What is 59 and a half anyway? Why do we have a half birthday? Like 401ks, IRAs, you got to wait till you're 59 and a half. You can access the money in a cash value policy next Tuesday. If you've got the money in there, it's your cash. Third, it is available with no taxes due if we designed it correctly. The tax law says it's income tax free. Both principal and gains can be accessed with no taxes due if we designed it correctly. And finally, when you borrow against the policy, there's a loan feature, which essentially is like creating your own bank for yourself. When you borrow against these policies, the policy's cash value will continue to build and grow, even on the capital you borrowed. Mm-hmm. So this last one, I got to say one final thing, then I promise to get off my soapbox. Okay. But if let's say I've got $200,000 in cash value, right? Let's say I borrow out $80,000. Maybe I want to fix up a condo or fix up an apartment building, rental, whatever. I'm working on one of my properties, and I borrow $80,000 against my policy. That year, I'm still going to get growth and dividends on all $200,000 as if I hadn't touched the 80 grand. And I've got the 80 grand out there in the plywood and the nails and cement and whatever else working for me, getting yield in the real world too. So we just increased the overall return of your portfolio with no additional market risk. I mean, that to me beats paying cash. So anyway, that's, maybe I'll pause again there. Let's go for it. What questions or feedback do you have?
So just to clarify, so you get a whole life policy. Let's say you get $1 million whole life policies. You have the death benefit of $1 million, and the cash value is what you already have into it, and what the insurance company is giving you credit for in the way of cash. So let's say it's $200,000. You pull that cash out, that $200,000, you can use that to buy a property, pay cash for the property, or put a down payment on a property, what have you. But at the same time, the insurance company is still giving you dividends on the entire million, even though you pulled 200,000 out. So the whole million's growing in there, the value of the million. But now the money you pulled out, this is where I want to kind of dig into next is that actually pulling the money out, or are you borrowing against the money? It's still there. What happens if you don't pay it back? Some of those kind of questions are coming to my mind. I'm thinking other people might be thinking the same thing. And is it possible, let's say you have an inheritance. Let's say you inherit $1 million. Can you buy $1 million whole life policy, or can you put $1 million into whole life and maybe you get a $10 million policy, death benefit with $1 million cash value? Is it an even exchange like that, or is it actually better than that? Or kind of like, let's use that scenario. Let's say you do inherit $1 million. What would be a good case study for that with the whole life insurance process of using that to be your own bank?
So, your money has to live somewhere. Yeah. Let's just, be real basic here. It's either going to go into a taxable savings account. Your $1 million is going to go into a CD, money market, savings, brokerage, all of which are exposed to taxes and, in some cases, fees and market risk in some cases. But the key piece is every time I spend $1 out of that $1 million to go buy a latte or a real estate deal, it's no longer earning me any interest in the vehicle that I withdrew the money from, right? Mm-hmm. If I take a $500,000 out of my $1 million to go buy a real estate deal, all I have is the drywall and the lumber and everything down the street. I no longer have it earning any interest. Not like it was earning much anyway in the savings account, but it's no longer in there. I've now only got it over there and down the street in my real estate. So contrast that now to the whole life policy. If you put $1 million, which is possible, into a whole life policy, you would have access to the money, much of the cash value, in the first 30 days after starting that policy. There's some insurance costs to buying the insurance. So if you had $1 million and dumped it into a policy, you might have a $10 million death benefit depending on your age and health. And your cash value might be $950,000, let's say, in the first year. Okay. So right there, you can see there was an expense to buying the life insurance. And this would be a special kind of life insurance, Gary, called a single premium type policy, which has its own classifications. Won't bore your audience with all the details today. But if you were to borrow against that life insurance cash value, you're not actually withdrawing the money out. You're simply using the cash value as a source of collateral for the loan that came from the life insurance company. And by the way, Gary, this is a life insurance company that you are an owner of. Okay. So since it's a mutually owned life insurance company, that's the very particular type of insurance companies we would want to work with. If we're designing this the bank on yourself way, working with a publicly traded company, you don't get any of these benefits. Like, MetLife or something is publicly traded. But if you work with a mutually owned life insurance company, you're going to get the dividends and the profits and the benefits of being an owner of the company. So if you were to borrow against your cash value, the policy's cash is still whole, inside your policy. You've just borrowed against the general fund of the life insurance, or you borrowed from the general fund of the life insurance company, and now you've got that big wad of cash in your bank account. You can go spend it at Home Depot, or you can, use it for any reason. And meanwhile, your cash value is still cooking and growing and earning as if you hadn't touched a dime of it. Now, why do they do that? Why does the insurance company offer that? And what's the catch? Well, if I was to do that, let's say I had, again, sorry for those driving down the street, but if you got, $1 million of cash value and 10 million of death benefit, and you borrowed out $500,000 to go invest in some real estate, and then let's say I passed away that evening, my family would get 10 million minus the loan of $500,000. So the life insurance company is self-collateralized. That's the $20 cocktail term there.
Okay.
So they're self-collateralized. If I never pay that loan off, the insurance company is relieved because they no longer have as big a liability to pay my family someday.
Okay.
If I do repay it, and this is really cool, if I do repay the money, it's on my terms. I get to decide, or Gary, you would get to decide exactly, hey, I want to pay this off when the property gets flipped. I'm going to pay off this loan. I don't want to pay anything until 3 years from now or a year from now when I flip this property. There's a lady up on the East Coast. She does some really great high-end luxury home flips. And she'll put $700,000 into a home, an old antique home, make it look beautiful in today's standards, and then sell that thing and use the policy for the $700,000 loan. She's her own line of credit to herself, doesn't have to call a bank. The money is sent from the insurance policy into her bank account within about 4 or 5 business days. And then she sits on that money, deploying it into construction. And then when the house sells next year or whatever, she'll pay off the policy loan and then repeat the process. Recycling the money is way better than throwing it out the door. So that's kind of the overall process.
Okay. And you're saying you get to actually determine, so if I borrow against the cash value, I'm borrowing from the whole life company against the cash value of my policy. So I can determine when I pay that back. Is that?
That's
okay.
right. Yeah. There's no required repayment plan.
Okay.
And the insurance company again is self-collateralized, so it's a safe option for them to lend you the money. So I should mention this too. There's no underwriting for the loan. They're not going to check your credit. They don't ask you what the money's for. You can go on trip to Disney World, or you can use it for real estate. So it's unlike a self-directed IRA. There's no prohibited transactions.
Okay. And what about who do they determine the interest rate, or is there are you accruing interest on the outstanding balance, or how does that this is my banker's brain kicking in. I'm trying to rationalize the difference between the two,
Oh yeah. Well, there's some ways in which it's sort of like a HELOC. If folks are familiar with how HELOCs work, I'll explain similarities and differences. I'll answer your question too. So yes, there's a loan interest that's charged. That's why they're able to call this a loan, why it's tax-free when you borrow, because loans aren't considered income to the IRS. So it's all income tax-free when you borrow the cash out. And the interest is set typically in your contract with the insurance company. And they cannot just change that willy-nilly on you. It's written right into the contract. So that's kind of a nice feature. But when the interest is charged, as it always is with policy loans, who gets paid? Well, the insurance company. And Gary, who owns that insurance company? You and me.
Yeah.
So it comes back to us in the way of dividends at the end of the year. Now, contrast that to a HELOC. A HELOC, first of all, we still have to beg for a banker's approval. There's no longer any interest benefit to getting a HELOC. You can't pay off you can't deduct your home interest on a HELOC on your taxes. There's nothing guaranteed about our home value. It could go down, and they could call the HELOC on us like they did in 2008. Life insurance is guaranteed to grow every year, so you'll never be underwater with life insurance like you might be with a house. So in some ways, there's some similarity with a HELOC. A HELOC will grow. My house grows whether I've got a HELOC or not, So in that way, I'm getting my money doing two things at once, kind of like I do with the policy.
Yeah. Now, I guess, so thinking through this, if you could, so you can only borrow against the cash value of the property. Is it possible for I'm thinking like a banker now, is it possible for a whole life company to lend you money even against the death benefit of your policy, if you had, say you already had $1 million in real estate somewhere, a big piece of land or a big building or something like that? The whole life companies, insurance companies have the ability to lend money against the death benefit of your policy, where they would be named, I guess, as a beneficiary in case you did get hit by the proverbial bus, collateralizing against the value of those other assets. Or can you do it like a commingle? You can be partially capitalized by your cash value and the other asset, or
That's great. No, okay. Gary, I love the creative thinking, and you're right. To think like a banker is really where this starts, more so than products and loan interest rates and all the details we've been doing today. It's the thinking that really changes everything here. Mm-hmm. When you think like a borrower, you'll always be under the thumb of a bank. If you think like the banker, you can start to profit like banks do. Guys, banks are the biggest building in my town, probably yours too. So think like the banker, right? Banks are older than the pyramids. I would actually add that. There's a great book out there by David Graeber called Debt, the First 5,000 Years. Wow. And that's saying something about where banks have come from, right? So, but anyway, to answer your question, you can use your cash value. There's two assets sort of on the balance sheet when you have a whole life policy. It's really one technically, but it's functionally like two assets. You have your current asset, which is your cash value. Banks would call it a current asset. Your cash value is a current asset, meaning I can use it now. The future asset or deferred asset is the death benefit. And I can use both of those in my negotiations with a bank. So if I walk into the bank, there's the old scene from It's a Wonderful Life where, what's his name? Jimmy Stewart hands his life insurance over to banker. Well, you can do that. I've got a lot of clients who will walk into the bank with their well-funded 6 or 7 figure whole life policy cash value, their current asset. And they say, hey, Mr. Banker, I got these 4 or 5 properties. I've got this 6 figures of cash value. I've got this savings account. Give me a line of credit, and we'll use the life insurance in part as collateral for the traditional bank loan. Once again, we're now using the bank for our convenience rather than letting the bank come to us with their terms. We're coming to the bank with ours, and that's really where control comes in. So there is one way or a couple of ways you can use the death benefit as collateral as well, maybe outside the scope of today's meeting, but you are using your current assets for all of your financial life. And again, you can fire your banker. The key thing to remember is to use the bank when it makes sense to, and use the life insurance as another tool in the tool belt. Yeah.
Okay. Good. Okay. Now, I know we got to be conscious of the time here too, but I know we got a few minutes left here. Any other thoughts, or actually, here's a great question. My attorney asked me this one time. What questions am I not asking that would be good questions to ask? So is there anything I haven't asked you that you can think of, this is an important component of this, or maybe even an example that would help plug one of the holes or the gaps in knowledge? And, it's the old saying, sometimes you don't know what you don't know, So.
Yeah, well, you're right. That is such a great learner's mindset question. What do I not see? It's a great question to start your journal entries with. I try to, what do I not see right now? Because those are usually the biggest bear traps in our life. When I make those stupid mistakes, it's because I rushed into something without seeing the unseen, so to speak. So what downsides? Let me kind of share those. Life insurance is an asset that costs something to buy, just like real estate or anything else. So there are insurance expenses. So you lose some purchasing power in the first couple of years. So again, if I was to put in a large lump sum of cash, I will have lump sum minus insurance expense, to equal my now new asset that I can use and spend these special ways we've been describing. So don't do bank on yourself type whole life insurance if you need every dollar right now and have no real focus on a future growth. The key here is long-term compounding that never stops. With a savings account, you get every penny in your savings the day after you deposit it, but you've lost quite a bit of other options once it's in the savings account, like returns and tax-free nature and more, right? So we are buying life insurance. So don't look at this as a get rich overnight kind of strategy. Yep. I would also say you do have to have something saved, or the ability to save, live within your means. And that's another downside, or at least a filter. Don't do this if you're in debt up to your eyeballs and have no desire to save anything, or would rather spend it on Saturday night. So those are some kind of filters, I guess, that I would say this doesn't work for those in that space. Otherwise, it can be a long-term living asset that we can use for our kids' college or real estate or our own tax-free retirement.
Yeah. Well, I love the whole idea. And I do know people that do this and several different walks of life. So it's funny because I've been around quite a while and I've never done it myself. And I'm looking ahead. I'm a year away from that proverbial 59 and a half. And so I'm thinking instead of using more traditional retirement vehicles that, sometimes you put money in and it's tax deferred and then you pay taxes when you pull it out. Others are you're putting in money that's already been taxed and then it grows tax free and you pull out later on tax free. And I'd love to have you back on the show to talk about maybe some of those relative to real estate too. But in any case, this is one thing I think I'm going to do in the next year is put some of my liquid capital because I have no debt right now. Put it into a whole life policy, start using that process, let it grow, and then my kids are now in their late 20s and 30s, grown, married, have their houses, all that kind of stuff, and I'm thinking they think I'm a maverick because I'm constantly on the go and traveling everywhere, and they want to check on me. Kind of funny, but so it'd be a great way for me to pass on the financial legacy to them safely and really let them reap the rewards from all my efforts all these years. And same time, still give me the ability to stay active in the investing world, So this is a real opener. Yeah.
Well, with 90 seconds, could I leave a bonus tip for those that might be in a similar? So in this case, imagine where you've got a big tax deferred 401k or self-directed IRA. And you leave that to 2 kids, 3 kids. I don't know how many kids you have, but we can guarantee at this point that if you were to leave your IRA 401k to more than one child, the biggest beneficiary of your IRA would be the Internal Revenue Service. If I've got a $200,000 IRA, let's say I leave it to 2 kids, that'd be $100,000 each, right? 100 grand, 200 divided by 2. They're going to be now bumped into their highest tax bracket because they're going to receive that money. And so let's say that's 40% now. 40% of 100 is 40,000 times 2 kids is $80,000. The kids are left with 60 grand, each of them. The IRS gets 80,000, 40 times 2 kids. So the IRS is the biggest beneficiary. Now, for those listening who might have more than one beneficiary on their IRA after their spouse passes, is there someone at the IRS you're especially fond of that you'd want to leave the vast majority of your IRA balance to the IRS? No, there's a better way. You can put that money into a life insurance policy slowly, pay your taxes on your rates slowly, and then get it into the policy so that it's income tax free to the wife or the kids or whatever. And now it's, you've multiplied the gift without the IRS's proverbial hand in the pocket, so to speak. So just an extra bonus tip for folks. Yeah,
and I really appreciate that. I know one of the things I've been really fearful of, my parents are now in their 80s and I listen to all the politicians talking about, raising the inheritance tax or raising capital gains taxes and all this stuff. I'm thinking, I'm the one to put in my own blood, sweat, and tears all these years to grow this.
Right.
And I've already paid taxes, tons of them. I mean, it's ridiculous. I mean, there's years I paid taxes that were more than the top 5% wage earners in the country make.
Right.
And, so I feel like I paid the dues on that. And why should my family have to pay more dues? It's just like they're stealing, So with this whole life policy, I'm guessing what you're saying is that it passes to your beneficiaries, the heirs, when you pass away, and it's not a taxable event,
Right.
That's right. That to me is, if anybody listening right now, that last statement should have piqued your interest for almost more than anything else. If I better stop there because I'll get political and but I tell you what, if you could do this, we're kind of getting short here, but if you wouldn't mind, Mark, share with everybody, how can we get a hold of you, website, email, if there's any type of special report, something they can start to sink their teeth into, because I want everybody to get a hold of you. This is such a vital subject to any estate plan for anybody who's professional business owner and investing,
Yep. We're all over the place. We have a podcast, Not Your Average Financial Podcast. Check us out there. Nice short name, Not Your Average Financial Podcast. Okay. But then you can also just reach out and we can have a quick 15-minute phone call, guys. Go to bit.ly, that's bit.ly/Mark Banking. Mark Banking. go to that landing page and be happy to reach out. My calendar is right there. We can chat one-on-one.
Okay. And I'm writing this down, the podcast. So it's Not Your Average Financial Planning Podcast. Is that what it is? Or did I get that?
Everything but the word planning, just the simple Not Your Average Financial Podcast.
Gotcha. Okay. Not Your Average Financial Podcast. Okay. So everybody remember that. Not Your Average Financial Podcast. Check it out. Subscribe. Give Mark a good review, or also give this podcast a good review when you listen to it.
Give Gary a 5-star review. He does it's a hard thing to be a host, guys. So take a minute. You say it all the time, Gary, so I'm saying it for you, man. Go give Mr. Gary Wilson a 5-star. He's done a great job on his show.
Thanks, Mark. I appreciate that. And for everyone listening, we appreciate your participation. The numbers are growing. We decided to relaunch on our own this past fall, rebrand and relaunch, and it's working well. Just being who we are and focusing on you and what your needs are. So go ahead and subscribe to the podcast. Massive Passive Cash Flow Podcast. Go to the website, guys. I'm going to emphasize this more. Grab yourself a certified investor agent. It makes a huge difference. If you've invested with other agents, I'm not knocking them. They're wonderful people, but they're typically not trained to work with us. These folks are absolutely trained and certified. They're often investors themselves. You can get them. Go to the website, realestatewithgarywilson.com. Click on members area. On the right-hand side is where you can check it all out for free, including going to the community site where all these investor agents are. And if you're an agent, by the way, you'd be crazy not to participate in this. I mean, the business we literally grew 44% just in the month of April, and it's not even over yet. So if you're an agent and you want to invest, or you like working, you want to learn how to work with investors, you should check it out. Go to the website, realestatewithgarywilson.com, and be part of the winning team. It's wonderful to get an average of more than 4 commissions per client versus 1 for every traditional owner occupant. 4 times better. It doesn't get any better than that. So, in any case, Mark, back to you, man. I really appreciate you taking your valuable time to do this. I know you're busy, you're a successful guy, and I really appreciate you doing this. And I want to have you back on again to talk about some other subjects that I think deserve exploring. Everybody, including Mark, by the way, is God bless you and your families. Take care of yourselves, and we'll see you on the next podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.